Interest rates don't usually make headlines the way wars, elections, or stock market crashes do, but when they change suddenly, they quietly shake the entire economy from its foundation. One decision made in a central bank meeting room can ripple through households, businesses, governments, and global markets within weeks, sometimes days. Mortgages become more expensive overnight. Stock prices swing wildly. Currencies rise or fall. Jobs appear, disappear, or freeze in uncertainty. Sudden interest rate changes are like pulling a lever that controls the flow of money itself. To understand what really happens when interest rates jump or drop without warning, you need to see how money moves, who gets hurt first, who benefits quietly, and why these shifts can either stabilize an economy or push it closer to crisis. Consumers feel the shock before they understand it. When interest rates change suddenly, consumers are usually the first to feel the impact, even if they don't immediately know why their financial life feels tighter or looser. A rapid increase in interest rates makes borrowing more expensive almost instantly. Credit card interest rates rise. Variable rate mortgages adjust upward. Car loans become harder to qualify for, and monthly payments jump. Families who were already stretching their budgets suddenly face higher costs with no increase in income. This reduces discretionary spending. People delay vacations, stop upgrading phones, and cut back on dining out. When rates drop suddenly, the opposite happens. Borrowing feels easier, refinancing activity explodes, and consumers feel a psychological boost that encourages spending. The key truth is that consumer behavior drives a massive portion of economic activity. When households pull back due to higher rates, businesses feel it fast. When households spend freely due to lower rates, economic growth accelerates. The danger of sudden changes is speed. People don't have time to adjust their finances, which can cause panic decisions, defaults, and long-term financial stress. Businesses freeze, accelerate, or collapse based on cost of capital. Interest rates directly determine how expensive it is for businesses to grow, survive, or fail. When rates rise suddenly, companies that rely heavily on borrowing, especially startups, real estate firms, and capital-intensive industries, face immediate pressure. Expansion plans are paused, hiring slows, and layoffs become more likely. Projects that once made financial sense no longer do when financing costs spike. CEOs and CFOs shift from growth mode to defense mode almost overnight. On the other hand, a sudden drop in interest rates acts like fuel. Companies can borrow cheaply, refinance old debt, invest in new equipment, and expand operations. This is why central bankers like Jerome Powell or Christine Lagarde must be extremely cautious. Too sharp a move can destabilize planning across entire industries. The hidden reality is that uncertainty is often more damaging than the rate change itself. Businesses hate unpredictability. When rates change suddenly, even strong companies may delay decisions simply because they can't forecast costs accurately. That hesitation slows economic momentum across the board. Financial markets react faster than the real economy. Stock markets, bond markets, currency markets respond to interest rate changes instantly, sometimes violently. A sudden rate hike often causes stock prices to fall because future earnings are discounted at higher rates, making companies look less valuable on paper. High-growth stocks suffer the most because their profits are expected far in the future. Bonds react differently. When rates rise, existing bonds lose value, causing losses for investors who thought bonds were safe. When rates drop suddenly, stocks often rally, bonds rise in value, and risk-taking increases. Currencies also swing sharply. Higher interest rates usually strengthen a country's currency because global investors seek higher returns, while lower rates can weaken it. These rapid market movements can create a dangerous feedback loop. Falling stock prices hurt consumer confidence, which reduces spending, which then slows the economy further. The truth is that financial markets don't wait to see how policies work, they react to expectations. Sudden interest rate changes amplify fear or greed, often overshooting reality before settling into longer-term trends. Housing and real estate become the economy's pressure point. Few sectors are as sensitive to interest rate changes as housing. When rates rise suddenly, mortgage affordability collapses quickly. Buyers disappear, home sales slow, and prices can stagnate or fall. Construction companies halt projects, real estate agents lose income, and related industries from furniture to home improvement feel the slowdown. For homeowners with adjustable rate mortgages, monthly payments jump, increasing the risk of defaults. This is how housing downturns can trigger broader economic recessions. When rates fall suddenly, housing often heats up rapidly. Demand surges, bidding wars return, and prices climb. While this can boost economic activity, it can also inflate housing bubbles. if growth becomes disconnected from income levels. Central bankers like Alan Greenspan learned the hard way that prolonged low rates can encourage excessive risk-taking in real estate. Sudden rate changes don't just affect buyers, they reshape entire communities, local tax revenues, and household wealth. Housing is emotional, personal, and financial all at once, which makes its reaction to interest rates especially powerful. Governments face hidden consequences and debt pressure. Interest rate changes don't only affect individuals and businesses, they directly impact governments. When rates rise suddenly, the cost of servicing national debt increases. Governments that rely heavily on borrowing must allocate more money to interest payments, leaving less for education, healthcare, and infrastructure. This can lead to austerity measures, tax increases, or political instability. Countries with weaker economies or high debt levels are especially vulnerable, as investors may demand even higher interest rates to compensate for perceived risk. When rates drop suddenly, governments benefit from cheaper borrowing, which can stimulate spending and economic growth. However, this can also encourage excessive debt accumulation if leaders assume low rates will last forever. The financial truth is that governments often act more slowly than markets, making sudden rate changes particularly dangerous. Policy mistakes made during these transitions can lock countries into years of economic struggle or inflationary pressure. Employment and wages shift with a delayed but powerful effect. Jobs don't disappear the day interest rates change, but they are affected deeply over time. When rates rise suddenly and businesses pull back, hiring freezes appear first. Then over time disappears. Eventually, layoffs follow. Wage growth slows as companies protect margins. This delayed effect can make rate hikes politically unpopular, even if they are necessary to control inflation. When rates fall suddenly, job creation often accelerates, especially in construction, technology, and consumer-driven industries. Wages may rise as competition for workers increases. The challenge for policymakers like Jerome Powell is timing. Act too slowly, and inflation can spiral. Act too quickly, and unemployment can surge. The labor market is the human side of interest rate policy behind every data point. Is a household adjusting to fewer opportunities or sudden optimism? Sudden changes magnify these effects, making economic transitions more painful than gradual adjustments. Income inequality and global spillovers widen fast. One of the least discussed but most powerful effects. Sudden interest rate changes is how quickly they reshape inequality both within countries and across the world. When rates rise abruptly, asset prices like stocks and real estate often fall, but the damage is uneven. Wealthier individuals usually have diversified assets, financial advisors, and access to fixed-rate borrowing that shields them from immediate pain. Lower and middle-income households, by contrast, are more exposed to variable-rate debt, rising living costs, and job insecurity. This widens the gap in financial resilience almost overnight. On a global scale, sudden rate hikes in major economies, especially the United States, can trigger capital flight from developing countries. Investors pull money out to chase safer, higher returns, weakening local currencies and increasing the cost of imported goods. Governments in these countries may be forced to raise their own rates sharply to defend their currencies, even if their economies are fragile. The result can be slower growth, social unrest, and debt crises far from where the original rate decision was made. When rates drop suddenly, global money floods into riskier markets, sometimes creating short-term booms that collapse just as fast when conditions reverse. The financial truth is that interest rates don't just manage inflation or growth, they redistribute power and stability. Sudden changes accelerate that redistribution, often leaving the most vulnerable with the least time to adapt. Sudden interest rate changes are never just technical decisions, they are economic earthquakes that reshape behavior, confidence, and power. They influence how people spend, how businesses invest, how markets value risk, how governments manage debt, and how workers experience opportunity or insecurity. While gradual changes allow adaptation, sudden shifts expose weaknesses that were hidden during stable times. This is why central bankers are both powerful and feared. One move can calm inflation or ignite recession. Understanding what happens when interest rates change suddenly helps you see the economy not as an abstract system, but as a living network of decisions reacting to the price of money itself. And in that network, speed is everything. The faster the change, the deeper the impact, and the harder it is to reverse.